So on the rate front, it's all well told about the backup in the long end of the U.S., but I think what is less discussed is the fact that this tightening liquidity environment and the fact that for the first couple of years after the Fed started raising interest rates, we still saw loosening financial conditions. They're now tightening, but we're on the cusp of getting less liquidity outside the U.S., other global central banks, in an environment where global growth is already slowing. And then on the trade piece, I think one of the things that was really unsettling for markets in the last couple of weeks is that actual companies are coming out now and talking about the impact that this is going to have, whether it's on profit margins, pricing, how they're going to react to it, paring back on CapEx expenditures. So I think those two, as sort of forces contributing to this volatility, aren't going away anytime soon. And I think the earnings season is going to be very much about listening to companies talk about what is to come as opposed to focusing on the earnings that have already happened.
Well, Russ, when it comes to earnings, it's been interesting season so far. Many of the industrials, as Lizanne kind of referred to, have not had particularly good numbers, have at least raised concerns about the trade picture. At the same time, some consumer names today, for example, Procter & Gamble, now maybe independent to it because it seems to have gotten its act together, but nonetheless, very strong numbers. Where do you come down where we are so far when it comes to earnings and the forecast as well?
I think generally we are seeing some sort of intimations regarding concerns about tariffs, concerns around input costs. But let's be clear. U.S. earnings are exceptionally strong. They've been powering the bull market. This has been the one unambiguous strength this year. I think the problem is really threefold. One is, as Lizanne said, it does come down to the unknown of tariffs, which I do think has the potential to bite more in 2019 than it has so far. Second of all, we should also keep in mind that a lot of those good earnings have already been discounted. And the problem this year has not been earnings growth, it's been multiple contraction. In other words, less willingness to pay for a dollar of earnings. And then finally, I think this point of tightening financial conditions is very important. The real economy looks to be in decent shape. Certainly the tax cuts have helped. The problem for financial markets is we have a lot of asset classes that are stretched. And there's some fragility in the system. And as financial conditions tighten, and that's not just about higher rates, it's also about a stronger dollar, potentially wider spreads, that is going to inflict some pain on certain asset classes, even if the underlying economy is doing okay.
Lizanne, you wrote a note, I guess about a week ago now, where you pointed out that the best stock returns tend to come when economic data is weaker, not stronger. Also pointing out that stocks have an uncanny ability to figure out when the data is at or near its peak and just beginning to roll over. Do you think that's happening right now?
Well, I think there are some second derivative adjustments that are happening right now that are sort of under the radar. In fact, let's talk about the leading indicators, which came out this week from the Conference Board. One of the ways that they put out that data and what the headlines tend to pick up on is not just the change in the LEI, which continues to be strong, but the contribution of the 10 subcomponents. And this week's headline was, 8 out of 10 subcomponents contributed positively to the LEI. What that doesn't pick up, though, is that measures level. You can have an indicator, say like building permits or ISM new orders, that has rolled over and the trend is now negative, but because it's coming down from a high level, it is still contributing positively to the index, which is why I always say when it comes to the relationship between economic fundamentals and the stock market, better or worse matters more than good or bad. And I think the stock market's ability to kind of sniff out those inflection points, I think is something we are going to be forced to digest more now than we have in the recent past.